Welcome to the Critical Few Actions to Improve Your Business podcast. I'm John Downs and I'm here to help you cut through the overwhelm and prioritise what matters most to improve your business. Let's get started and discover the critical few actions that have the biggest impact. Today, I welcome back Fiona Hansen to share her experience and approach to valuing customers, brands, and other intellectual property. As I mentioned in our previous episode, Fiona's been working in the valuation space for over 20 years, and I often introduce her to clients when they have valuation challenges. Fiona, welcome.
Thank you very much, John. It's an honour and a pleasure to be here again.
It's a delight. Fiona, today we're going to talk about how medium business founders and CEOs can come to terms with what intellectual property they have and how it might be valued. Perhaps we should start with why should they care? Or more specifically, when do they care?
To answer your question, John, valuing intellectual property often costs money in terms of consultants actually doing the exercise. CEOs and CFOs don't really care until they actually have to get it valued. They just watch that share price if they are listed, and they just put one step in front of the other if they're a private company. They don't really care. But it does come to a really good point where you have to value your intellectual property for the purpose of a sale. For example, just recently we were doing a valuation for a company that was a mobile betting company, and they were selling to another mobile betting company. And obviously they had their customer lists and of their punters, whether they're active right down to their inactive, as well as also their platform and how they had the smarts to get the punters to actually continue betting on their website rather than going elsewhere.
Right.
So we were tasked to do the valuation of their customers, being the active ones, the ones that come back once a year just to do the Melbourne Cup, and those that pop in every so often, or every 2 years or so, and those regular customers. So that was because they wanted to work out what is the value to them and what is a potential value to the buyer.
Wow.
We do the same thing with the system as well. There was quite a bit of smarts behind a system to keep the punter engaged. And it all came down to the profitability of the business compared to comparable businesses. So the more a business with intellectual property can generate in terms of profit, so profit margin is high, that means that you really exploiting your RP, whether it's customer relationships or RP or brand, to the maximum extent.
So that's a really interesting case. So you've got two dimensions of intellectual property there. One, which is the systems, the IT systems, the platform, the app, which is stimulating, encouraging the customers to invest or bet. And that's no different from whether they've got a betting system or a Shopify store selling retail fashion. But then they also have their customers, which often people say, yeah, it's just about the revenue. But actually there's probably, as you just highlighted, three dimensions there. There's the regular customers who just keep coming back. Then there's the irregular customers who come perhaps once a year or they're event driven. And then there's the third customers who are pretty random, may or may not come back ever again. And you might have hundreds of thousands of customers that put on a bet 2 or 3 times and then never come back, or maybe they come back as their circumstances change. So how do you go about the process of valuing both of those two assets, the IT or the systems or the applications, and the customer bases in their segments? Can you take me through that process?
2 very big questions, John.
Yeah.
And
we've got some time.
Some of our clients pay a lot of money for an answer.
And the reason they pay a lot of money is not because they like you, which I'm sure they do, but simply because that's going to help them get the best value for their exit and give them a better bargaining position when they're negotiating with various other buyers. Yeah. Trying to look at, okay, is this buyer actually buying me for my app, or is this buyer buying me for my customer base? So take me through how you might go about doing that.
Bear in mind, before I even start, that if we're doing a valuation for a client who's going to negotiations with a potential purchaser of their assets or their business, they won't show potential buyer their valuation. That's in their back pocket. So the valuations we do can never be used to compel a buyer to buy at that price. So
no, it's to help you have a fully informed seller.
Yeah. Yeah.
Of course, the buyer might be the one who's asking you to do the valuation as well, but either way, it's to help make a data-informed decision, yeah?
90% of the time, the buyer is probably doing the same exercise with the
Yes.
ladies in the due diligence, the data room. Anyway, so let's get back to the system. So systems nowadays are very complex, and a lot of developers are continually developing selling systems. So whether it is an online store or an online retail store, whether they're selling clothing or personal goods or
Industrial spare
and so on.
parts or...
If you have a favorite website that you buy stuff from all the time, 9 times out of the 10, every couple of weeks, you'll see something else tweaked and changed, and there's another little thing, and there's something else and something else. Those developers are working 24/7 using research and tracking customer behavior and seeing what other similar stores are doing and other companies similar are doing, and they're all trying to get ahead of each other because they're all competing for the same eyeballs and the wallets of these customers. It's a continual process, and so it's a bit like research and development, but also the coding. And if you think from an accounting perspective, the more people you have actually clicking on the cart and paying, the more dollars you're coming through your company. That's the software system actually working. And if you can task the customer to spend more than they actually want to, that drops the profit down to the bottom line. So that is really valuable. It's becoming more valuable stores, the bricks and mortar stores, the Maya window, which doesn't really entice people to spend a lot of money anymore. But it's the smarts around people shopping on the web, and before they know it, they're spending $200, $300 more than they anticipated. And that's where the value is in the system. There's a couple of different methodologies in which we use to value the software. The very basic one, and most of these methodologies are in what we call the International Valuation Standards, which globally, hopefully, valuers will start complying with. But at the moment, they're just used as guidelines. But they are quite describing in terms of the methodology. So the first methodology would be the cost approach. And basically, the approach there would be to work out what it would cost to develop the software today, given the functionality the software has today.
So that's like a replacement cost.
Yeah, exactly right. So you go through line by line, how many developers, how long would it take, what was the rent that they used, how much lighting, all the costs that would be involved for a developer or a team of developers to sit down and recreate that system as it is today. And that would probably give you just the pure cost, and it doesn't take into account the profitability capability of the software. But then we have either the income approach or the market approach. So the market approach is not necessarily appropriate because it's very hard to go find another system out there exactly like the one that you're trying to value. For example, if you want to buy a Tesla, you can just look at the garage next door and there's probably another Tesla the same for sales. The market approach is not necessarily appropriate. So then we come to the income approach, which is generally the discounted cash flow methodology. And if you think of Microsoft and some of these other packages, you would sign a license arrangement to the software. So there is filings on what we call royalty rates. So you pay a license fee for the software, and we trawl the databases to see if we can find a similar kind of software, not exactly the same, but a similar kind. And if you don't own the software, you could probably license the software like you would your Microsoft that you have. You've got a license agreement, and that is expressed as a percentage of sales. So we use that to apply to the sales of the whole business that we assessed is in relation to the software. So if the whole business is run on using the software and nothing else, then you can probably conclude that all of the revenue of that company is driven by the software, which is often the case. So then you apply the royalty rate to the revenue, and you've got to get a revenue stream. And first of all, you project out the cash flows of the company or project out the profitability of the company for over 5 years or so. You convert that to cash flows. I'm just doing a bit of a shortcut here for you. You apply the royalty rate to the projected revenue. You discount the royalty stream after tax to a value, and you come up with the value of the software.
Right.
So try to dumb it down a bit for you. Try to dumb it down for you.
Yeah, no, that's absolutely perfect. And dumbing it is probably appropriate for me. So really you've got, there's 3 approaches there. One is, what would it cost me to rebuild it? The second one is, what's the market approach, which is really actually comparing it to like other products that are like that. And maybe in the case of your betting company that was largely systems focused, you might be able to turn around and say, okay, if basically the business was doing nothing but actually offering a bedding product, we could compare the market value of those things. Or the third way would be to actually look at, okay, so what are the income streams and the discounted cash flows associated with doing that? So that sort of makes quite a lot of sense for IT systems, packages and apps. When you were saying we look at the replacement cost, I just think, gee, that must have changed dramatically in the last 12 months with the advent of artificial intelligence, which is so effective and time efficient for generating vast amounts of code. So what it might have cost 2 years ago to replace an IT system, I suspect is somewhere probably even 20 or 30% of that now.
Correct in one respect. But then again, you didn't in those days have developers working 24/7. So yes, it might be easy to use AI to go and search the web. Oh, I want that slab of code. Bang, put it in. But you've got to keep doing it. Actual fact, it's actually costing more to develop sophisticated systems nowadays than it did. Even though the hourly rate would have come down and the smarts were there and more efficient to build, you've got to be on 24/7 to keep improving and tinkering with your system to get it even better and better.
Yeah, so I guess really what you're saying is all that's actually changed is that the speed of development, the intensity of development has actually just accelerated. It actually hasn't changed the cost or reduced the number of people who are actually doing it.
Yeah.
Yeah.
Companies, and you'll appreciate some of these online companies, just to name a few, probably JB Hi-Fi or Adore Beauty, or those that are purely online, they spend swags and swags of dollars
Yeah.
developing their system.
And of course, their competitors are doing exactly the same. So that's actually a really good example of how artificial intelligence hasn't actually reduced cost. What it's actually done is it's augmented capability.
Yes, exactly right.
And also probably going to be adding to the cost as well.
Yeah.
Interesting. All right. So that helps us understand that when we've got a core system that is really intrinsic to us generating revenue, then we can value that as part of it.
Yeah.
Then we talked about our customer bases and how do we actually value a customer base.
Yeah.
And so how do you go about doing that? You were talking about the bedding scenario. I think that's really a good case to drill down on further. How do you go about doing that?
Okay, so we think about the same way again. You can either go buy those customers.
Yep.
So in the US, either rightly or wrongly, there's some parties who have customer lists that you can go buy at 20 cents in the dollar, and there's a market price for a list of phone numbers and names and email addresses. You can do a cost approach on that, but you don't know how good you don't know the quality of that customer base.
Yep. So that's your replacement value approach. Yeah.
Yeah, like the software, that will give you the base value, the lowest possible value for the customers of the software. And then you can go to the market approach, but probably quite hard to do. And then you've got the income approach again. So what we typically do is we get a customer list from a company and we ask for 3 or 4 years backwards. And then we calculate. So for each, we go line by line, each customer, what is the attrition? So if they were there in year 4 or 4 years ago, were they there 3 years ago, were they there 2 years ago, were they 1 year ago, and today. So then we just do some maths and we work out, what is the churn? How often do they churn? So then if we look at the customers today, so we're just looking at the customers we have today, not the new possible customers. So it's customers that we got today, and they will generally tail off. So we use the attrition to calculate the tail off, and each of those 3 buckets we're talking about, the active ones, the once a year, and those random ones, have a different attrition. So we've got to value them separately. So they're like the regular ones might have a very low churn. So you might lose 2% a year, but the annual ones, then you might lose 50% of them a year, and so on. And again, we use the same forecast cash flows for the business, and we apply the churn. And obviously we're valuing all the customers. We use all the revenue because we don't have any cash customers in this situation. Everyone's got a name because it's all online. And we do the discounted cash flow. Again, that's a simple way of doing it. So we come up with the value of the customers using a discounted cash flow, what you call a multi-period excess earnings methodology.
Right. Okay. So again, fairly similar valuation techniques, but applied to a different set of income streams or a different set of values. So when I then look at, say, brands like Louis Vuitton, Coca-Cola, Microsoft, and so on, so much of their balance sheets actually is tied up in this thing called intellectual property,
Yes.
which is really about the brands themselves.
Yes.
Are you looking to pinpoint the areas that will make the biggest impact on your business? Check out the Organisation Performance and Value Diagnostic. This powerful tool lets you evaluate your business on multiple facets and provides email reminders to keep you on track. Head over to CriticalFewActions.com.au and get started now. How do you go about looking at that intellectual property from a valuations perspective? Is it actually simpler because really you're saying, okay, anybody anywhere in the world can actually sew a handbag? However, there's a bit of a difference, perhaps a couple of $1,000s or perhaps tens of thousands of dollars in difference between one handbag and another, which has got an amazing brand on it.
So it really comes down to finance, I would call it, in terms of really understanding. Before we even start with the numbers, we need to understand, what does the brand represent? What attracts the customers to the store or to the business to purchase? Is it the Louis Vuitton? Is it the name? Is it the logo? Is it the colors? What do customers feel about when they say Louis Vuitton? Is there any artistic impressions around the brand? So all these things come together. So we really need to think about, is it a premium brand? And then you look at the bottom line of the company. Is it generating premium profits? How much protection is around that brand? So again, you consult some databases for royalty rates or license fees. Like Pepsi or Coca-Cola around the world, every country licenses that brand and the recipes and the packaging. So brand is a big question. So you really got to distill down, what are you valuing and what does it represent? And then you go and find comparable royalty rates for licensing of very similar things and apply it to the cash flows. If all the goods you store out of the store are labeled or branded Louis Vuitton, then it's easy. But if it's only 20%, then you apply it only to 20% of your total sales. Yeah, but then the danger is, though, getting carried away about valuing all these different intellectual property. We mustn't lose sight of the fact that they can't be worth more than the value of the business as a whole. But you've also got hard assets. Part of the exercise is to, like a jigsaw puzzle, add all these values of the intellectual property and the hard assets together. And on the other side of the equation, do a valuation of the business and see if it fits. You can't have all these assets worth more than the value of the business.
And I guess that comes down to the old approach to looking at what was the value of intangibles, was simply to say, okay, if we sold the business and the business was sold for $100,000 or $100 million, doesn't make any difference, and the net assets, hard assets of the business were 60, then 40 million was the gap. And we'll call that goodwill, or we'll call that intellectual property or intangible assets. And so I guess what you're saying there is the valuation of those brand systems, assets, designs, etc., can't be more the gap, that 40 million.
That's right.
Unless, I guess, you turn around and say, yeah, but the business is being run so poorly that in anybody else's hands, that intellectual property actually would have far greater value.
Yes, exactly right. Businesses, as you see in insolvency situations, the businesses fail not because of the business, but because of poor management. And that's a really big debate. For example, let's take the situation of Virgin. So before the GFC, Virgin was worth $3 billion. And then during COVID, I'm talking about COVID. So when COVID hit, all the planes were grounded, costs were higher than revenue.
And therefore, there was no value in the business at all.
There's no value in the business at all. So do you say that the value of the Virgin brand went from, let's call it, I don't know, $1.5 billion before COVID to zero during COVID, and then now Virgin's worth about $3 billion again. So is it?
So did the brand devalue, or did actually just the operations devalue?
Yeah, you can't have the brand worth more than the business. That's a big dilemma. Would you pay for the Virgin brand anything during the COVID situation?
And I guess that is the question, because what actually happened during COVID, the transaction for Virgin?
That was the case when Virgin collapsed.
Yeah.
because it still had to pay the staff. It still had to pay for the engineers to go and turn the engines over on the planes every month. They still had to pay the license for their slots at all the airports. They still had all these costs to pay, and their staff. So it had all these costs. And Bain came in and paid basically $1 for the business. They assumed all the liabilities and paid nothing else. So it was mostly staff provisions and staff entitlements that they paid for. And Bain has more than 3 billion times their
investment.
For the investment. That's right.
Because
So
they took a bet that we would survive COVID.
interesting, yeah. So you can see where a brand like that, a well-renowned brand, no one would buy
No.
Virgin at the time, because you need really deep pockets to bring the business back. That's a big question. How much would the Virgin brand be worth?
Yeah.
Knowing that you had to put maybe $1 billion into the business to get a 3 billion out.
Yeah. Yeah.
Mm.
So we then, that sort of then brings me to this issue of web-based companies. So we talked about the betting business, and one of the things that sort of comes to mind there is, how does the market, as opposed to a technical valuer, how does the market value some of these web businesses, whether they be information services or education businesses or gaming businesses? And the venture capital obsession or the private equity obsession is, what's the annual recurring revenue, or what's the annual subscriber base? And all of a sudden, whether the business seems to be making in its early years any profit at all, it has this amazing valuation based purely on revenue. How does that work? I know I was working with a logistics technology business, which basically a business that matched parts of the logistics supply chain together. When I first started working with it, it was losing money because it was largely in development phase, but it did have clients and a lot of customers in 8 or 10 countries. What transpired was that we very rapidly tried to get it into a profitability state, because obviously that helped it stand on its own 2 feet. But a public company came along and offered effectively 100 times its EBIT, which happened to be only 10 times its annual recurring revenue. If we looked at that another 24 months later, we would have turned around and said the business was still only of marginal value. But that's because the economy had died. There seems to be often a fairly substantial gap between what the market's prepared to pay and what the traditional valuation techniques would suggest it's worth.
Yeah. You're referring to SaaS type businesses?
Yeah. It's the software as a service businesses.
Yeah. That's an interesting phenomena. Then when they got the annual recurring revenue, as you said, with the hope of making a profit down the track. I think probably a fad, and I think it's also driven by a number of things. I think private equity like to have a diversified portfolio of their investments. They'll have safe investments and ones which are a little bit more risky, and maybe they'll go out and limb and have a SaaS type business in there, because who knows? We don't know where these companies are going. They're still trading at pretty high multiple. Is it a bubble? And it seems to be that if one private equity comes in at $10 and stays their life of 3 years or 5 years and exits, and they sell it at $12, the next one comes at $12 and they hold it for another 5 years, and then they sell it at $15. It's self-fulfilling in a way.
Yes, so people are just getting carried away with it. But it's not just an experience that was occurring during the dot-bomb era, because I would imagine that right now we're seeing the same thing with AI businesses. If we were looking at the top 5 AI platforms at the moment, I suspect, but I don't know, that a lot of them are pouring a truckload of money into the technology development, and I'd be surprised if any of them were actually making any money, particularly as they're giving away the content and the product for free at this moment in October 2025. But I would suggest that Wall Street would be saying that the likes of ChatGPT and Claude and Perplexity and so on would be worth pretty substantial multiples on, frankly, I'm not sure what.
Yeah, it's like the Facebook phenomena for many years. Wasn't making money.
Yeah, nor was Amazon.
It wasn't making money, and the punters punting it, and I suppose it's the belief that one day it will turn a corner, and you've got something magical there, and it's going to cost a lot to get it to the point where it does become profitable. So I think it's a matter of those punters, deep investors, keep investing and pouring money in to get the competitive advantage, the first mover advantage. And as you say, some companies have poured billions into AI development, but just have collapsed. It takes deep pockets too. And as alluded to earlier on in the conversation, things are getting much more sophisticated. Things are much more costly these days, and it costs a lot. And a SaaS type business, you just keep developing. It's that click revenue, and you just got to keep going on this hamster wheel until
Indeed.
until payday comes. And who knows when payday comes? And if you hang in there long enough, payday is going to be big.
Yeah. Yeah. But we're also talking about taking a bet. There's a substantial risk involved in that, which can be mitigated with experience and research and analysis and a whole bunch of things.
It's not too dissimilar to a lot of small business startup businesses. You got the journey to
Yes.
there. So that's why so many small businesses fail, because the entrepreneur, the backer, doesn't have deep enough pockets to go that extra mile to get it over the hump and pin halfway. It takes 3, 4, 5 years to get a business off the ground, and so many fail before then because people can't afford to keep funding them.
Yeah, they can't afford it, or maybe they don't have the experience, just because passion alone won't carry you through. I'm a great believer that every overnight success takes at least 10 years and probably costs twice as much as you very first expected.
Exactly right. And translate that to a SaaS business, you multiply that not by 10, by
potentially hundreds. So then when we bring all of this discussion around valuation approach down to earth in the context of a medium business owner or CEO, how does knowing this affect them as I build my business and ultimately prepare it for sale or transition down the family?
Good point, John, and something that a lot of business owners should pay attention to way before they want to sell, because it is an investor-ready type period, and buyers like to look at a track record. So profitability and cash flow is king, and the quality of your customers goes hand in hand with that. The quality of your customers will drive profitability. Look after the quality of your customers, profitability will come. Likewise, your systems. You've got good systems working and exploiting to the highest possible extent is going to drive profitability. So the bottom line is work smarter, not harder, and get all these intangible assets to work for you. And yeah, it does take a huge amount of investment to get them right. But once you've got them right, keep them ticking. And if you're driving the profitability, the good quality systems, you've got a good brand, you've got good customers, people are going to pay a good multiple for a business like that.
Yeah. So we've got a business that's operating well and is operating profitably. And I've got an exit strategy which says, okay, in 3 years, I'm going to put this on the market. Knowing what we know now about valuation approach, but also the elements of intangible assets, what should I be doing to prepare for an exit event over the next 3 years, apart from running the business? Well, is there things that I need to do that make it easier to articulate the value of that intellectual property?
I think there's a couple of questions you need to be thinking about along the way. As you have experienced in some of the work we've done together, going with a trade buyer, you'll probably get a higher price than institutional or a financial investor, because you can probably get some synergies. 1 + 1 = 3. If you bolt two businesses together which have got similarities or complement each other, you can get a much higher valuation, and a buyer with a similar sort of business gain that extra uplift, is prepared to pay more. So I think it's not only looking at your own business, start combing the market to see what business you could partner up with down the track, and even start conversations around what will it look if, like in a merger. Yeah, M&A doesn't happen overnight.
No, it
It's
doesn't.
a long gestation period like an elephant. And that's how you maximize value. No rush sale, do it over time, control the process, but make sure you've got a really good quality business that is not going to fall off the perch when you withdraw.
And actually, I guess that's another part of the intangible value of a business, and that is its dependencies on key operators, staff members, intellectual property that are walking around with 2 arms and 2 legs.
Yes.
And so if the CEO is 65 plus, planning on leaving the country and going a fantastic lifestyle that they haven't had while they've been married to their business instead of their family, then that's actually a point of risk which would discount the price.
Exactly right. Exactly. Or else owner is being tied to the business, has to expect to be tied to the business for a little bit longer until new owners have got the confidence that they don't need him anymore and things have transitioned and nothing's lost along the way. And a big thing, as you and I know, accounting firms be bought and sold after 3 years. Really, not many of the accountants, the partners that were purchased, remain. and
Yes.
neither do their clients. In a people type business, that is a real big risk. But nowadays, when you're talking online businesses, that's not such a big risk because you've got, as we said, a lot of AI, a lot of technology running the businesses more so than people.
Yeah. So I guess when we're talking about intellectual property, which is that intangible stuff, we're not just talking about brands, we're not just talking about IT, not just talking about designs or about customer base. We're also talking about the actual leadership of the business and its continuity as well.
Yes, as we said, a business doesn't fail because of the bad business. It's about bad management. But you flip that around, a business is successful, not necessarily only because of the business itself, how it's structured, how it's operated, but the good management.
Yeah,
So you need
absolutely.
good management to get the cogs to turn very efficiently and work extra hard.
If you really want to kick off your strategic planning and work in a supportive environment with other CEOs and leaders, the CEO Masterclass in Strategic Planning and Implementation is for you. This 10-month small group course helps you craft your strategic plan, present it to a group of peer investors, and develop a habit of monthly implementation. Our waitlist is open now at criticalfewactions.com.au. So Fiona, final question. If a founder or a CEO is looking to capture and leverage the value of their intellectual property in their organisation, what critical few actions should they start tomorrow if they did nothing else?
Good question, John. A very good question. And I don't think many business owners do this. I think it's a matter of taking a blank piece of paper and sitting down and working out what are the drivers of value of your business. What is actually driving the profitability of your business? Is it the product? Is it the customers? Is it the brand? Is it the systems? Is it the channels? And if you only find one of those levers, if it's the brand, why are the customers helping? Why aren't the channels to market helping? Why aren't your IT systems helping as well? So if only one is driving your profitability of your business, you should try and get a few more drivers of value so that you're actually anchoring and you've got a bit more balance. So you're not all the eggs in one basket kind of thing.
Yeah, absolutely. And I guess that sort of brings us back to that organisation performance and value framework that I love so much. For me, it's those 6 levers. Do we have a clear vision and a clear strategy? What are the mechanisms that we use to actually build our revenue? How do we actually retain profitability from the revenue that we've created? How do we support our people to perform? How do we get better value and return from the assets that we've got? And how do we actually measure and monitor the business so it's continuously being improved?
Absolutely. And you got nailed it on the head.
Fiona, I'm going to incorporate all of this into our IP Valuations ebook that goes with this episode. Thank you so much for your time. It's been really illuminating.
Thank you very much, John. It's an absolute pleasure and always fun talking to you. And I learned a lot about what you've got to say, and I hope the audience can take something away from the podcast today. So thank you so much.
It's been a delight. Thanks for listening to the Critical Few Actions podcast. Don't forget to subscribe and grab the downloadables from the show notes. And if you found this episode helpful, I'd really appreciate it if you share it with your peers and your team. Stay focused and take action. The Critical Few Actions podcast, including show notes and links, provides general information only and is not individualised business advice, nor can it be relied upon as such. You must take responsibility for your own advice, decisions, and actions.